Right now, massive amounts of capital, literally billions of dollars, are pouring directly into the physical hardware that powers artificial intelligence. We saw the scale of this in May, when NVIDIA reported revenues topping $80 billion, almost entirely driven by the demand to build out massive data centers. Samsung matched that momentum, projecting an 1,800% jump in quarterly operating profits, over £43 billion. This chart reveals a stark market contradiction. Following these massive earnings announcements, both companies watched their stock fall by nearly 7%. Breaking records is no longer enough. Investors are looking past the top-line numbers and zeroing in on the fragile mechanics of exactly how these companies generate that cash. This diagram shows why. AI hardware isn't a monolith. It requires two distinct technologies working together. First, the brain. Complex compute engines, or GPUs, where NVIDIA holds a near monopoly. Second, short-term memory. High-capacity storage feeding those processors, where Samsung dominates. NVIDIA caught the initial media frenzy, but the rush to build data centers triggered a severe bottleneck in memory chips. That bottleneck has quickly turned into the most lucrative secondary market in the tech sector. To understand those stock drops, we have to pull these two halves apart and evaluate them as completely separate strategic investments with entirely different risks. Let's start with NVIDIA's compute engines. They are the undisputed gold standard for AI processing. Their hardware is deeply integrated with their own proprietary software. It is incredibly difficult for rivals to replicate, which gives NVIDIA absolute pricing power. That technological moat is exactly what drove their $80 billion quarter and caused their market capitalization to more than double since the start of the year. But that dominance creates a valuation trap. Because they are the primary engine of the AI boom, the market has already priced in years of flawless performance. The margin for error is zero. The moment analysts see even a hint of rising competition, investors sell off to protect their gains. Buying NVIDIA today is a stressed bet that no competitor will catch up. They race alone, pushed to the edge of their mechanical limits. Samsung's 1,800% profit jump is built on an entirely different foundation. High-bandwidth memory chips are a complex, manufacturable physical commodity rather than an exclusive software ecosystem. Samsung didn't rely on a proprietary new invention to get these margins. They capitalized on a massive global supply squeeze that allowed them to aggressively hike prices across the board. This pricing power holds up only as long as demand from AI data centers continues to outstrip the amount of chips factories can physically produce, a dynamic expected to last through next year. So while that £43 billion profit is very real, it is temporary. It is entirely tethered to cyclical commodity pricing. This historic quarter is a symptom of a bottleneck. The moment global supply catches up, those high margins are completely exposed, and the rest of the Asian manufacturing sector is currently racing to close that exact gap. South Korea views semiconductor production as a critical national asset, and they are mobilizing massive sovereign resources to protect their technological lead. The government recently unveiled a plan to inject at least $880 billion into new chip manufacturing projects over the coming years. Samsung's primary domestic rival, SK Hynix, is aggressively expanding to capture the exact same market. Their stock has jumped more than 200% this year. Simultaneously, firms in Japan, China, and Taiwan are investing heavily in massive new factories of their own to meet the soaring demand. Eventually, this massive wave of new factories will resolve the supply bottleneck. That will be great for AI progress, but it will be fatal for the premium pricing that Samsung currently relies on. We plot growth potential against cyclical risk. NVIDIA sits in the upper left. They offer high growth with moderate cyclicality, acting as the industry's structural foundation. Samsung sits in the upper right. They offer high growth but extreme cyclicality, dependent on the current supply squeeze. If you believe AI data centers are a permanent addition to the global economy, the foundational compute designers remain the safest long-term play, even with their high entry prices. By taking that route, you trade the chance for short-term, explosive profit jumps in exchange for a wider technological moat and lasting market dominance. On the other hand, attempting to capitalize on the current memory bottleneck requires timing the market cycle absolutely perfectly. If you take this route, you have to actively track global factory output. The moment those new facilities come online and supply catches up, the high-margin window shuts. This is exactly why we saw those initial 7% stock drops. The market is already looking past today's earnings and pricing in these exact vulnerabilities. There is a constant friction between sky-high valuation expectations and the slow, physical reality of building and shipping hardware. In the current era of AI hardware, an 1,800% profit jump is no longer a guarantee of a stock bump. It is simply the new minimum requirement to stay in the game.